Meet Mr. Daniel, who is happily married with a kid. Daniel is concerned about filing his tax returns for the year 2023 due to limited knowledge of U.S. tax filings. Here are the earnings and expenses of Daniel for the year 2023. Total income equals $120,000. Child care expense equals $6,000. Mortgage interest paid equals $12,000. Let's now help Daniel how to calculate the taxes. Income tax is tax on money made from jobs and other sources. This is the single largest revenue source for the United States government. The tax is used to pay for public goods like roads, schools, libraries, and first responders. The United States tax code has been progressive since the 1860s. Under a progressive tax code, people who make more money are taxed at a higher rate than those who make less money. There are several advantages of the U.S. government adopting progressive tax code. First, it increases government revenue by collecting more from those who can afford to pay more. Second, it eases the burden on lower earners and gives them a greater chance to achieve success. Progressive tax works by placing earners into different tax brackets according to how much money they make. Here is a table with different tax brackets. There are currently 7 official federal tax brackets, with rates ranging from 10% to 37%. The dollar amounts that define the brackets change depending on whether you are a single filer, a married joint filer or qualifying widower, a married separate filer or a head of household filer. Now that we know the tax bracket for different income ranges, let's calculate the taxable income for Daniel. A taxable income is also called adjusted gross income. Adjusted gross income is defined as total yearly income minus deduction minus adjustments minus exemptions. There are 2 types of deductions. Standard deduction. Here, you can deduct a fixed dollar amount set by the IRS. For example, for the year 2023, the standard deduction set for married filing jointly is $27,700. Itemized deduction. Itemized deductions can include child care expenses, charitable giving, education expenses, select business costs, mortgage interest, certain medical expenses, and more. Whichever is greater between standard and itemized deduction is used to calculate taxable income. Let's now calculate the adjusted gross income for Mr. Daniel. Since Daniel is filing tax as married filing jointly, he is qualified to use standard deduction. However, let's calculate his itemized deduction to make sure it is not higher than standard deduction. From what we know, Daniel had below expenses for the year 2023. Child care expense is $12,000, as he is sending his kid to daycare. Mortgage interest is $6,000. So his itemized deduction is child care expense plus mortgage expense, which is $12,000 plus $6,000. This is equal to $18,000. Since itemized deduction is less than the standard deduction of $27,700, it makes sense to use standard deduction to calculate the taxable income. So Daniel's taxable income is $120,000 minus $27,700, which is equal to $102,300. Now that we know the tax bracket for different salary ranges, let's calculate the taxable income for Daniel. Not all of the taxable income is taxed at the same tax rate. Now looking back into the tax bracket table, here is how tax is calculated for Daniel. First, $22,000 is taxed at 10%, which is $2,200. Amount from $22,001 to $89,450 is taxed at 12%, which is 12% of $77,450, equal to $9,294. And the remaining $12,850 will be taxed at 22%, which is $2,827. This top tax bracket to which Daniel falls, which is 22%, is called marginal tax rate. So the total tax Daniel needs to pay for 2023 is $2,200 plus $9,294 plus $2,827, which is $14,321. Thanks for watching. Don't forget to subscribe to the channel. Come back soon for more productivity videos.